Hey, welcome back to another episode of BYOB Squared Podcast. Here with me, Josh Click, and your other co-host, myself, David Zapata. We're going to talk today again about becoming your own banker, and we're going to share a beverage and have a good conversation between friends.
Yes, sir.
Cheers, my friend. We do these conversations because we like spending time together, sharpening our thinking, getting aligned in what we see in our businesses, in our family.
Mm-hmm.
The financial area of our life happens to be very, very important to us. It's how we find abundance in our life. And we want to share that conversation with you in case anyone watching finds value from what we talk about. So, Josh, today we're going to talk about something that is true and dear to our hearts, the idea of infinite banking, the infinite banking concept, an idea that Mr. Nelson Nash crystallized in his book, Becoming Your Own Banker. You and I, since finding it in our own lives, have become passionate about sharing it with
Absolutely.
others. So let's go right into it. Let's share screen really quick, and then let's start talking about this. So let's recap what we talked about in the last episode. Opportunity cost. Tell us about your thoughts about that one more time, please.
Yeah, opportunity cost at the big view is you make a decision and there is an opportunity cost of that decision, which would have been had you made an alternative decision. So if I decide to invest in property A, the alternate decision would have been investing in property B, and then if property B performed better, then that was an opportunity cost that I incurred by buying the other property. So every decision we make in life has an opportunity cost. If we decide to hit snooze instead of getting up with our alarm clock, there's an opportunity cost.
Yeah,
we lost time. What would that 5 minutes have done for us? With money and business is where we typically see opportunity costs, but at the end of the day, every decision we make throughout the day, we could have decided something else, and so there's always an opportunity cost at play, and we should value that and look at what is the cost of our different opportunities, but we also can't let it drive our life.
Yeah. I mean, it would be overwhelming. That's the truth. For every yes you have, there's 1,000 no's. Yeah? For every time you go and play with your kid at the park, you're saying no to events, to networking, but the value and getting clear about the value of spending time with your son, if you love your family, for example, if that's important to you, it's a no-brainer. So balancing the calculation of 1,000 opportunity cost ideas that are in the background is a really important word of caution. And just one more word on this. I love a quote from Buffett that he says a very simple sentence: the best way to mitigate risk is to think. And I think it's so simple, but it's so brilliant, right? Like sometimes we are making decisions, and part of thinking is also considering, what do I not know that I don't know? What else is out there that I should be considering, whether it's where you put your money, like we talk about constantly, or more ideas about yourself. Is you're thinking accurately? Are you having the best relationship you can have with your wife, with your friends, with your family? So I think there's a powerful idea to entertain here. Hopefully you enjoyed that episode. For today, like I mentioned, we're going to be talking about what is IBC. And full disclaimer, Mr. Nelson in his book, the first page says that this is a 10-hour course and 10-hour required exposure to really understand and catch this idea. We're not going to do that here. We're going to give you a brief overview of what we think encapsulates.
Tune in for the next 10 hours on this one episode.
Yes, he used to do that. So yeah, props to Nelson. But today we're just going to walk you through how we think about it, how we have conversations with clients to introduce the idea and the basic premises of it. So would you walk us through this definition here of infinite banking, Josh?
Yeah, so infinite banking is the process of becoming your own banker through building cash value in a dividend-paying whole life insurance policy where cash values can then be loaned against to access your money without having to go to banks or lenders. That's it at its definition. And I know without a doubt there's going to be people that have just heard that definition and their automatic response is going to be, whole life is the worst investment in the world.
Yes.
We've already touched on that in prior episodes because whole life is not an investment. It is an asset. It is a savings vehicle, and it is the premise to make this concept work because of the contract that goes along with it and how it operates. And there's not another environment that is as certain as whole life in which to do infinite banking.
Perfect. Okay. Yeah, and I'm sure people watching this may have different opinions, different definitions for it. Of course, we're trying to stay true what Nelson describes in his book, but at the core of what we are talking about, we're talking about a process of capitalizing yourself or your business or your family, which is as simple as just accumulating money and taking control of it. That is more of a verb than a noun when we talk about banking. It's at the core of controlling money that flows through your hands so you can have, again, control and access. So that's a premise of it. We do it on top of a platform. And when you look across the entire economy and we look for the ideal platform or product to do this, we find no better product than Whole Life. It's the best savings vehicle there is in our economy. The reasons why we're going to touch in other episodes about, we'll walk through that with you. But in our view, we like to disclose that up front. So if you have preconceived ideas about that, I would just encourage you to be curious and to just consider a new point of view on that. You might be thinking something that somebody told you, but not quite understand. So that is another point here. And then access. Why access? Because as we established before, the problem we're trying to address is that we finance everything in life.
Right.
And in order to finance things, one needs to have access to credit or cash, or in this case, to the capital associated to a banking process where capital is within your control. You become the loan officer. You use the cash to hopefully acquire more cash flow.
Right.
And when the additional dollars come back, you're able to put that back in the system and control that flow uninterruptedly forever. So this is a basic premise. More important than that is let's break it down into a few pillars and a few ideas of the becoming your own banker thought, because I would argue, and I always say this in my presentations, in the book, if you look at the front page, it says becoming your own banker. The word banker is capitalized in red, the largest font. Mm-hmm. And of course, that's the focus of the conversation here for the activity of banking. But I continue to point out people to the word becoming.
Right.
Becoming to me is the action word. This is not Josh or me or anyone at Factum or any IBC practitioner in the country becoming your banker. We are actually in the business of stepping back and educating people, empowering them so they take action. They become the director on their own movie, the banker in their own life. If you take a step back and just take a minute and consider how many institutions, advisors are in your life, in your financial life, that try to educate you, to empower you to take ownership, you would not have enough people to think about with your counting with one hand.
Right.
Because their business is to take over so they can manage things for you, so they can charge advisory fees, so they can, right? And again, I'm not criticizing in the opposite. I'm actually clarifying what this is. We are not giving you that type of advice. We're actually not giving any advice. We are suggesting that at the core of the conversation we have in front of you is that the objective is to help you become the person capable of practicing the banking function in your life.
Absolutely.
Yeah.
And so in those three pillars that you mentioned before, obviously they're on the screen, but we'll go into each one of these: mindset, process, and product.
Yeah.
And mindset on our next slide is going to discuss what do we really need to make sure that we need to understand and adopt as our philosophy of thinking around this in order to navigate these steps. And then the process is that true navigation. So we understand the concept, we understand the operations, the necessity for it. What is the process to implement that? How do we become that banker? And then what product do we use in order to allow this banking function to operate?
Yeah, I love that. I heard this way of expressing this the other day that really resonated with me. How do you know Nelson was full of wisdom and wasn't really trying to put a scam? If you read Becoming Your Own Banker, you'll see the first 20, 30 pages are nothing but a conversation about human behavior. Mm-hmm. Things like Parkinson's law, right? Mm-hmm. The idea that income rises, expenses will rise, and you have to be very aware and conscious that you need to keep a portion of everything you earn. Otherwise, everything is going to keep coming out the way it comes in. Right. The same is true for time. Time allotted for an activity, we'll take that. If you say it's going to take you 2 weeks to finish the projects, you finish it the last day and the second week. If you say it takes you 2 hours, it takes 2 hours, right? This conversation at its core initially starts with the ideas that you entertain between ear and ear. you have to have a certain mindset, certain idea, certain perception about what money is, what the role of money is, more broadly, what life, an ideal life looks like, and why money is important to fund that life, right? If you have those ideas clearly defined in your mind, you will start then engaging in the ability to learn the process, which is nothing else but a set of rules. Capitalize, pay interest to the system, make sure that you continue to keep control on the money, right? And then the product, like you said, unfortunately, the conversation, and by the way, we're being very intentional about the order of these things. Most conversations about this from people that are actually not professionals in this area or not practitioners of the Institute, the Nelson Nash Institute, will start this conversation on the product. And this is not a product conversation. This is not a whole life. Everybody that owns a whole life policy is not banking.
Correct.
Right. So you need to have a mindset and a process to be able to implement it in the right platform. And I think the ones that we're going to actually break down are going to be the basic steps that we teach when we're walking a client through the process for them to understand how to get to the implementation. We're going to talk about the problem, obtaining the right guidance, the process, and product. And the problem is something that you and I have talked now at length in a couple of episodes. Yes, but just to restate it, you finance everything in life. So you want to touch about any of the problems here? Any thoughts on the problem that are nuanced or things that you found in the next couple of months that make you reconsider the value of understanding what you're solving for?
Yeah, the problem is at its core, assisting with that mindset piece, the mindset of refinance, whether we're paying cash or using credit. There's an opportunity cost. There is a financial cost to that. And that cost of paying cash is the future interest that would have been earned.
Yeah.
And obviously the problem with paying credit is you're paying interest to someone outside of your own family, your own financial environment. It's going to a third party, and we're losing that interest for the rest of our lives. So we're either separating the interest from our environment, or we are giving up the possibility of creating interest in our environment. Mm-hmm. And that is the problem.
Yeah.
And to overcome the problem, we need to keep the interest in our environment.
Yeah. It's interesting that we're talking about this right now because I hear a lot of the conversation, interest rates rising, Powell just raised the rates again. Mm-hmm. So a lot of the conversation I hear from traditional planning or advisors out there is, right now you can take the opportunity to get a high yield savings account. Right now you can get really good returns on treasury bonds and things like that. But the key in that sentence is right now.
Right.
And
it makes 6 months.
Right. Sure. It makes me reflect on that and like the relationship people have with the environment in which they put money and not realizing that this is a forever situation.
Correct.
Like from now until whenever it is that we pass, and even after that for your kids and mine, right? We're going to have a relationship with how do we access money, how we control it. And my question, or actually my appreciation for finding this has been always like, I have forever solved for that environment by building a policy system that allows me to put dollars now in 2050, in 2060, however long I live.
Correct.
So I effectively have created a forever asset, a forever process for me to manage cash flow inside a vehicle that I own and control. I think it's at the core of helping people to help them see that this is a long-term situation. And he says in the book, your need for financing likely is going to be greater than your need for protection.
Correct.
During your lifetime. So I think that that is very important. The obtaining guidance, I'll share a thought with you, but I'd love to hear what you think about this. To me, one of the biggest realizations as a client and when I started studying this was that I wasn't purchasing shoes. I wasn't purchasing a car, right? This was not a transactional product. Mm-hmm. I needed a relationship because becoming something, becoming someone, it's a process. And yes, the biggest, the most honest thing I tell people when we talk about this, whether it's me or somebody else, when you are raising your hand and you're saying, yeah, I understand the problem, I have that problem, I want a solution for it, therefore I want help. When you're engaging in that help, obviously you need to make sure it's somebody qualified, that is a professional that is doing things themselves, right? They have policies, they understand the banking process.
Right.
Hopefully somebody associated to the Nelson Nash Institute. But beyond that is likely you're going to have a relationship with this person for the next 30 to 40 years. I hope it's somebody you like hanging out with.
Absolutely.
So What thoughts do you have about that in terms of asking for help? Like, because you've gone through the same process of becoming a client and this becoming a powerful idea for you to share with others. So how do you think
Correct.
about it?
Yeah, the obtaining guidance piece, at least for me, was making sure that my guide could, one, help me understand this at the rudimentary level, but two, as I came up with dozens of questions that is not at the entry level IBC stuff.
Yeah.
Of future planning and structuring and all these things. My guide was able to, one, answer my questions,
Yeah.
two, admit if he didn't have the answers, and if that was the case, connect me with somebody who did have the answers. And being in a network of individuals to where, yeah, I don't know everything, but I know this person and this person and this person who are more specialized in those different areas.
Yeah.
And I mean, I'll relate it back to real estate. You're not going to go to a commercial broker for a residential purchase.
Yes.
And even within IBC, there are people with IBC that specialize on structuring key man policies for businesses. And that's a bit different of a nuance than saying, let's build the family banking system.
Yes.
And so getting into an environment that has professionals in each of those categories, of people who are honest enough to say, I don't have that answer, let's talk to so-and-so, I think was paramount in me feeling like I was in the right organization,
yeah,
in order to take that step and say, yes, I want to do this.
Yeah. So I love the way you express this, because you're right. It's just like in real estate. What's the advice? Build your team, right? You need to get a group of advisors for title, for everything else that you're going to do, that can guide you through that, so you don't develop that expertise, but you leverage it. And the person that is going to work with you through this should be no different. And as a matter of fact, what Josh pointed out is key. You're going to grow through this process. And as you become, this is going to have more nuance, more sophistication. This is going to connect to your estate planning, to your entity planning, to all these things. So hopefully you're working with someone that wants to build things with you, that grows with you, that is doing and engaging in that process of building and connecting things through the private banking system. So we'll leave it at that. Let's talk about the process, Josh, because this is the part that I think is fun. And this will be a little bit of a picture that we paint in one of our foundational courses, right? But I like this because it helps me visualize the difference between product and a process. So I'm going to walk you through this, and let's have a conversation. And at any point, if you have any thoughts, please. When we talk about the banking process, we're talking about creating a private institution for your family that, in its simplest form, it could look like a second checking account. Sure. That's it. That basic. I just want a place that becomes a designated location, an intentional location to manage money that goes in and out. And that can be a checking account. Guess what? When you get more sophisticated, you can create your own corporations with employees that manage loans and paperwork and all that. But at the you and me level, that's how I started. A second checking account. And this is where we send dollars out. And when we send dollars out, for at least my family, our focus recently, after doing other things, we financed debt, we bought travel, like all kinds of things, right? We are very focused on cash flow. And what does that look like? Josh has been one of the main influences for this in my family. Cash flow and real estate, right? What about loans? I have a goal with my wife to build a very large portfolio over the next 10 years so we can become lenders of private deals, real estate, a couple other things in our family, right? That's something that interests us quite a bit, to be able to facilitate liquidity to our community. Sure. That's something we want to do. Guess what else fits in here? Anything else? It's infinite. That's why it's infinite banking. But giving, for example, if you want to finance more effectively the dollars you give in charity to your church, to your causes, every time you give that cash never earns interest forever. But if you do it inside a banking process, you may be able to retain control of those dollars and do it more efficiently and actually give more.
Absolutely.
But the idea is that if you're doing it for cash flow, at least, like we recommend, those dollars will come back with more dollars. And the question becomes, well, where did the dollars that got into that checking account come from? And that's at the core of separating this. Banking is about moving the dollars in and out, controlling the flow, having control and access, right? And creating that control, and that control is created inside a vault. And the vault happens to be a portfolio of whole life insurance policies for us. That's what we recommend. When we create a family banking system like Josh and I are, we might be insuring mom and dad and creating policies through mom and dad. Maybe the generation before, grandparents get insured and the children get insured. And all that value accumulated that creates inside that contract a relationship between my family and the mutual insurance company that we use for those contracts. So in the hypothetical case, let's say there's $1 million of value in my policies.
Sure.
Okay. And I want to create some type of outlay from my checking. I want to send money out to purchase a piece of real estate. What would I do? What I would do, instead of touching the money that I own and control inside my vault, is borrow against that value, Josh.
Collateralize it.
Collateralize it. And why would I do that? Why would I not take this money and take it out?
Well, for one, if you were to withdraw the money, you would be forfeiting a significant amount of death benefit.
Yep.
Associated to that whole life insurance. Two, by withdrawing it, you would give up the future interest earned on that money.
Interrupt the compounding.
The compounding. And then three, it could, in some instances, create a taxable event.
Yes.
And what would be better is to say, I would like a loan against that money. And then the whole life insurance company is going to say, hey, it's your cash value. You have the right to loan against this. Here's your money. And what you see as your available cash value is offset, but that money is still there in its entirety working for you.
Love it. I want to stop. I stop there intentionally. If you hear somebody saying, I don't want to use my own money, I don't want to pay interest, they don't understand what they're talking about. They're not being specific enough. I want to be very clear with Josh about this. We're never touching every dollar that goes into my vault system in my portfolio policies will never leave that system for the rest of my life. Effectively, I'm keeping control of the physical dollars that I put in premiums every time I put premiums in a policy.
Right.
The way I will have access to them is I borrow against the general fund of the insurance company. So if Josh and I were to find a deal in Columbus, Ohio, like we've been talking about, and we're going to buy a home or a building, let's say a commercial building, and I need $100,000 to contribute to our partnership, I'm going to send the $100,000 out, but the $100,000 are going to come to my bank from the insurance company. And the insurance company is going to put a lien on my cash values for the first $100,000, right?
Correct.
I'm going to borrow against. And for the privilege to borrow against, I'm going to pay them interest. Am I upset about that? No. I think that when you use somebody else's money, the only fair thing is to pay them for their ability to lend you the money.
Right.
That's just basic economics. The insurance company is going to charge me 4 to 6%. Not a problem for me. But the important part here is that I will set the rules for my banking system that when I send money out, it needs to come back with a large amount of interest that I'm paying to the insurance company.
Right.
So for example, in my family, we would charge 10%. We paid the 4 and 6, and the additional cash flow that we captured through that interest that we earn goes right back into our policy system. This here is at the core of how we talk about never interrupting the compounding and always guaranteeing the access to the money through a guaranteed line of credit. Because the person, like you said, that decides how much and how much I borrow, when do I have to pay it, how do I have to pay it, is you. You are the loan officer of your life. It's an unstructured loan. It's a beautiful idea.
And it doesn't report to your credit.
It doesn't report to my credit because it's a private contract relationship with the insurance company. It's not a public record. That is a beautiful, beautiful way to manage, I think, access and control. Any other thoughts that I missed in this basic explanation?
I think you hit the nail on the head. The one thing I would add is that because you are the owner of that money, you don't need any specific reason, any specific qualifications in order to touch that money.
Yes.
The mutual insurance company does not ask you what it's for.
Mm-hmm.
They don't ask you to qualify. They don't ask for a loan application. The only thing they ask is how much and where am I sending it?
Yes.
And that makes this whole process incredible. Because if I go to any bank and say, even if I wanted $50 to go to the fair, they're gonna make me put down my social security number, go through a loan
I'm not sure what you
application,
mean. I've never done that.
all the things, just to get, pennies.
Yeah.
Whereas this, through your life and your children and hopefully your parents, like creating this family banking structure, there can be rules. Your family can create those rules and say, we're only loaning on these asset classes, or like your 10% interest as a requirement. Like that is all internal. That is your family saying, this is how we want our bank to operate in order to be the most effective banking system.
Yeah.
But when you're taking that money, the mutual insurance company isn't asking for anything.
Yeah.
All they're saying is, where am I sending the money?
Yeah, absolutely. It makes the process, incredibly powerful to put yourself in that position of the loan officer in your life, for sure. Okay, let's touch in the last thing, the product. So you said, what we hear more commonly about whole life. Oh, it's the worst investment. What is the common understanding belief of whole life is in society? Low rates of return, expensive to own, the worst investment of all life, of all time.
Mm-hmm.
If you hear Josh and I say something today and you memorize that, is one thing. Whole life insurance is not an investment. If you get clear about that, you will really start to see this as what it is, and then you'll probably be able to understand. And if you look at it as an investment, you will not ever get it.
Right.
Because it's the wrong comparison, is apples to pears. Okay. So I wanted to contrast that with this descriptions here on the right, Josh. And I want to have a quick conversation with you about that, because these benefits are incredible. And these words are not Josh's or mine. This is how banks describe what they get from buying bank-owned life insurance. Banks themselves, the best risk pricers in the world, will describe the reason why they put their savings and their profit in whole life with these words compared to what most people mention to us when they talk about whole life. So
right.
Should we quickly talk about a few of those?
Let's do some highlights. I know we've talked about all of these in prior episodes, so I don't think we need to unpack it, at depth, but just to kind of recap the uninterrupted growth, we mentioned that earlier, of even when we take a policy loan, the money that is in there is still compounding indefinitely. So that's the uninterrupted growth. Liquidity, we just touched on. We say, hey, we want our money. They say, where's it going? Guarantees, our whole life insurance is a contract. It is a guaranteed contract. It has to perform that way. And there's all kinds of different guarantees built into that.
And really quick pause. Ask yourself, out of everything you own, what else comes with guarantees? Send us an email. I'll be curious to hear what else comes with guarantees, because this is a very unique feature of this asset class. So,
yeah, when I had an IRA, there was no guaranteed rate of return, or pension, no guaranteed
absolutely
anything. So,
yeah.
Flexible loan provision. Again, we touched on that today. We just say, hey, we want our loan, and they say, here you go.
Mm-hmm.
Privacy. This is not reported on credit. I don't believe it even has to be declared, like if you're to file bankruptcy, that you have whole life insurance contracts. There's no way of creditors knowing that it exists, and even if they did, it's untouchable to them. It operates just like a trust, where it can't be touched.
Yep.
Passive income stream, that compounding over time is providing more income into the system. Tax rate transfer of wealth, when somebody who is insured were to pass, that death benefit is going to their heirs free of taxes. And then a high savings rate, the savings rate of at least the policies I have is around 4.25%.
Yep.
Is how much they're going up. And that is a contractual guarantee. It will always perform that way. If the economy gets even worse, it will still perform that way. If there is the best economy in the world, it will still have that 4.25%.
And just to make sure, because when we talk about percentages, the conversation gets diluted.
Right.
You are talking about a net rate of growth.
Correct.
Right? This is net of taxes, net of management fees,
Right.
net of everything. When people compare this to an investment, they'll say, oh, I can earn, and that's core to the conversation we were having. I can earn 7, 10, 12, and 10, and blah, 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 blah.
Right.
First of all, this is not an investment. You need to compare this to a checking account, to a savings account, to a CD.
Yeah,
Right?
the best comparison would be a high yield savings account. And even with a high yield savings account, there's no guarantee beyond 6 or 12 months as far as how that's going to perform. And I know right now with the interest rates being crazy and inflation and all that stuff, we're seeing a lot of high yield savings accounts saying, 5%, 5.5%.
Which is
stuff like that.
gross.
Correct. That interest is taxable.
Absolutely.
And that is a very short guarantee.
Mhm.
They're willing to do it for 3 or 6 months to get your money parked there, to get your account open, get you used to sending money there. But it will not stay that way. It will go back down to 2, maybe 3%.
It will fluctuate. That's the
And
guarantee. It will change.
Absolutely. The guarantee is that it's not guaranteed.
Yeah. Ask yourself during the 2010s when we had zero interest rates where those vehicles were and you couldn't find them. So
Yeah.
that's why having a forever relationship with how you manage cash in your savings environment is so important. So with that, I think we can conclude this episode. Thank you for being with us. Thank you, Josh, for a great conversation. We'll see you in the next episode.